Did you know that the rigid constraints of the gold standard once turned economic downturns into catastrophic depressions? In the early 20th century, this system was blamed for exacerbating the Great Depression and other economic crises worldwide. But how could a system based on something as solid as gold lead to such devastation? The gold standard is often romanticized as a period of economic stability and certainty, where paper money was backed by the tangible value of gold. For centuries, this system was the foundation of international finance, creating a global monetary order that influenced trade, investment, and everyday life. What exactly was the gold standard, and why did it have such a profound impact on economies? The concept is simple. Under the gold standard, a country's currency value was directly tied to a specific amount of gold. This meant that governments had to hold enough gold reserves to back every unit of currency in circulation. For example, if a country issued a currency note worth $100, it needed to have an equivalent amount of gold in its reserves to guarantee that value. This system gained prominence in the 19th century, with Britain adopting it in 1821, setting a precedent that many other nations would follow. The gold standard had several notable advantages. It provided a fixed exchange rate between currencies, facilitating international trade by removing the uncertainties of fluctuating exchange rates. It also limited the ability of governments to inflate their currency, as the money supply was directly tied to gold reserves. In theory, this was supposed to prevent hyperinflation and promote long-term economic stability. However, the gold standard also imposed strict limitations on monetary policy. Because the money supply was linked to gold, governments had little flexibility to respond to economic crises. During times of economic expansion, countries could enjoy prosperity as gold reserves increased through trade surpluses. But during downturns, the gold standard forced countries to tighten their belts, leading to deflation, reduced economic activity, and increased unemployment. This inflexibility would prove to be a double-edged sword, particularly during the tumultuous periods of the late 19th and early 20th centuries. For example, in the United States during the late 1800s, the debate over sound money versus free silver became a hot political issue. Farmers and debtors, who suffered under deflationary pressures caused by the gold standard, argued for the introduction of silver as a co-standard to increase the money supply and ease their economic burdens. The debate culminated in the famous Cross of Gold speech by William Jennings Bryan in 1896, where he argued that workers and farmers were being crucified on a cross of gold. Although Bryan's plea for bimetallism ultimately failed, it highlighted the growing discontent with the gold standard among the working class and rural populations. As the world entered the 20th century, the gold standard became more entrenched, particularly after World War I. Despite the war's economic devastation, many countries attempted to return to the gold standard as a means of restoring pre-war economic stability. But this return to gold would soon reveal the system's fatal flaws. The limitations of the gold standard became glaringly apparent during the Great Depression of the 1930s. The global economy was already weakened by the aftermath of World War I, and when the stock market crashed in 1929, the gold standard's rigid framework exacerbated the crisis. Central banks, bound by the constraints of gold, were unable to increase the money supply to stimulate their economies. Instead, they were forced to raise interest rates to defend their gold reserves, which only deepened the economic downturn. As deflation took hold, prices plummeted and businesses collapsed. Unemployment soared, and the world entered a period of economic contraction that would last for years. Countries that clung to the gold standard, such as the United States and Britain, experienced some of the most severe impacts. The US, for example, saw its industrial production drop by nearly half, and unemployment reached a staggering 25%. The gold standard's role in worsening the Great Depression led to widespread disillusionment with the system. Economists like John Maynard Keynes criticized it for being too inflexible to deal with modern economic challenges. Keynes argued that in times of economic crisis, governments needed the ability to increase the money supply and run deficits to stimulate demand and pull their economies out of recession. The gold standard, however, made such actions impossible, trapping economies in a downward spiral. The turning point came when countries began to abandon the gold standard in an effort to recover from the Depression. Britain was one of the first to do so in 1931, followed by the United States in 1933 under President Franklin D. Roosevelt. By severing the link between currency and gold, these nations were able to adopt more flexible monetary policies, which helped stabilize their economies. With the gold standard gone, countries were free to adopt fiat currencies, money that is not backed by any physical commodity, but rather by the government's declaration that it has value. This transition allowed governments and central banks to manage their economies with greater flexibility, using tools like interest rates and money supply adjustments to influence economic activity. The move to fiat currency allowed for more responsive monetary policies, which could be tailored to address specific economic conditions. For example, during the 2008 financial crisis, central banks around the world were able to lower interest rates and inject liquidity into the financial system to prevent a complete economic collapse. Such actions would have been impossible under the gold standard. However, the transition to fiat currency also introduced new challenges. Without the discipline imposed by the gold standard, some critics argue that governments became more prone to running large budget deficits and accumulating debt. Inflation, which the gold standard had kept in check, became a more common economic problem in the post-gold standard era. Moreover, the end of the gold standard did not eliminate the risk of financial crises. The global economy has experienced numerous crises since the 1930s, including the 2008 financial crisis, which highlighted the dangers of excessive debt and speculative bubbles in a fiat currency system. The legacy of the gold standard continues to influence modern economic thought and policy, while few advocate for a return to the gold standard. Its history serves as a cautionary tale about the dangers of inflexibility in economic policy. The gold standard also left a lasting impact on how we understand the role of money in society. The transition from gold-backed currency to fiat money fundamentally changed the nature of money, shifting it from a tangible asset to a tool of economic policy. This shift has allowed for greater economic growth and innovation, but it has also introduced new risks and challenges that continue to shape the global economy. Some critics of fiat currency systems argue that the discipline of the gold standard could prevent governments from engaging in reckless fiscal behavior. However, the overwhelming consensus among economists is that the flexibility of fiat currency systems is essential for managing modern economies, especially in times of crisis. If you want to explore this topic further, check out the video on the screen to expand your understanding of the fascinating history of money. Thanks for watching.